Equity mutual funds are the perfect solution for people who want to own stocks without doing their own research. These aren't my words, but of the legendary investor Peter Lynch, who has averaged a staggering 29.2% compounded annual return for 13 years, turning $18 million into $14 billion. Hi guys, it's me Vedant, and in this video we're going to discuss mutual funds. From now onwards, I'm going to share very interesting quotes from very famous investors regarding the topic which we're going to discuss. On that note, let's begin. Mutual funds is one of the words that we have heard too much and too often. You probably recognize it best from this.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Before jumping into what mutual funds are, I believe it is much more fruitful to understand what problems common investors like you and me may face while going and investing into stocks. And for that reason, I have broken up this video into 4 segments. The first discussing the problems, the second discussing what mutual funds are and how they solve the problems, third, the types of mutual funds, and lastly, parameters and other information to look out for. Let's begin with the first segment, the problems that you and me face. Well, with no proper background or knowledge, selecting a stock can become an extremely daunting task, and we often do not know where to even start. Because of this, we may end up taking random tips from people that are not so knowledgeable, and these usually backfire. Apart from this, we also know that we are not supposed to keep all our eggs in one basket, and therefore we must spread our money across quite a few companies. If we take suppose 20 to 30 companies, it might end up costing us 30 to 40 to even 50,000 rupees or more to purchase each stock, and this becomes extremely impractical for most people. So we have actually narrowed down the two main problems that common investors like you and me face. That is, one is lack of expertise and the other is the diversification problem. Now moving on to the next segment, mutual funds seek to solve exactly these two problems effectively. The money that is pooled into a mutual fund through many investors is handled by an expert called fund manager. Therefore, we delegate the decision making to someone more knowledgeable who will then go on to construct a portfolio from all the funds that have been provided. Because of the vast number of people that invest into mutual funds like you and me, the total amount that gets pooled up into these mutual funds often reaches hundreds and even thousands of crores. Because they have such large funds, the stock price no longer becomes a hurdle, and therefore they can effectively allocate all the capital. Let me explain this with a simpler example. Suppose there are 10 chocolates and 10 children. Each chocolate costs 10 rupees and each child has got 10 rupees. Let's assume that all the 10 children want one piece of each of the 10 chocolates. They do not want one entire chocolate, but they want one piece of each of the 10 chocolates. What they can do is they can come together, pool in the 100 rupees. Now buy the 10 chocolates, then distribute the chocolates amongst themselves according to how much money they have paid. So this way, one child could have gotten a piece of all the chocolates with just 10 rupees. This is how a mutual fund works. A lot of people pool in money and the mutual fund in turn spreads their money across all the different stocks. For providing this service and acting as this intermediate, the mutual fund charges a commission which is a fraction of the total money invested through their fund, and this is called expense ratio. So this is how the expertise problem has been solved because there is a fund manager who manages the money, and the diversification problem has also been solved because there are a large surplus of funds. The total portfolio is then broken up into smaller parts called units, and each of these has a price called net asset value, and the pattern that the net asset value traces gives us the performance of the mutual fund or the overall portfolio. So now let's move on to the third segment, types of mutual funds. Today there are many types of mutual funds and selecting them themselves becomes a big hurdle. Broadly speaking, there are 3 kinds: equity, debt and hybrid, which is a combination of equity and debt. Let's go over each of them. Equity mutual funds. These are mutual funds which invest the money only into stocks. they have subcategories among themselves as well, based on what they focus on, such as the size of the company or the industry they work in, and so on. An index fund has many similar characteristics to that of an equity mutual fund. All of the money is invested only into stocks, but there is no fund manager. The money that is invested into an index fund goes into tracking the index, and therefore it is a passive form of investing. It is a very practical way and should be looked at closely. Make sure to check out the video on index funds I have made if you are not sure about what they are. Debt funds. Debt funds are mutual funds which allow us to invest our money into bonds, debentures, and other fixed income instruments and have nothing to do with the fluctuations of the stock market. Debt funds work in a very similar way compared to equity mutual funds, in the sense the equities or the stocks are replaced with bonds, debentures, and other government securities, etc. These therefore have a much lower risk and often tend to have better returns compared to fixed deposits. Hybrid mutual funds. As mentioned before, these mutual funds incorporate debt as well as equity and try to make a more balanced portfolio overall. So now let's move on to the final segment, which includes the parameters that one must look out for. These include the expense ratio, the fund manager's experience and track record, the assets under management of the mutual fund, and the exit load. The expense ratio, as mentioned before, is the commission or the fee that the mutual fund charges for managing the money that has been invested into it, and therefore we must make sure that this is relatively less because these can eat into our profits. The expense ratio is generally around 1 to 2%, although this depends on the mutual fund. Fund manager's experience and past track record. The fund manager is completely responsible for all the decisions that are made regarding the portfolio. Therefore, there is a massive role that is played. Therefore, we must make sure that this person has a good track record, and we can also look at the other mutual funds that the fund manager is running simultaneously. Assets under management are the total sum that the mutual fund handles. When it comes to equity mutual funds, it is fine even when it is in hundreds of crores. But when it comes to debt funds, we have to make sure that it exceeds 1000 crores for sure. The exit load is another small fee that the mutual fund charges when investors sell their units. In case you haven't opened a demat account yet, consider using the link below to open your demat account with Grow. It is the broker I use and I have also covered it on the channel. That's it for this video, guys. Make sure to smash the like button and subscribe if you haven't already.